All right, guys. Well, we got another one. Okay, well, I'll go ahead and get the show on the road. I'll have a quick little intro, kind of overviewing it. I'll let Dean say a piece about his experience with the program, and then we will open it up for Q&A, okay? So we'll keep this nice and simple. Uh, okay, so I do want to start off with giving you guys the big picture strategy. The goal of this program is to alleviate a lot of the problems I've seen in the last decade of being involved in this business of uh, trade alert advisory services. And so there's a few things you'll find about our program that are a little bit different than most other programs out there. First and foremost, I think the most valuable thing is that you can predict when the trade alerts will come out and have a very passive lifestyle in terms of your investments. So you will know that Monday, Wednesday, Friday at noon Eastern exactly, the trade alert will be delivered, and we're not going to touch the portfolio outside of those times. That means that you can count on exactly when to be ready, you can do your work in less than 5 minutes, and then you can relax. So that's number one. Number two, our trade alerts are extremely conservative. So half the time we have this, we call it FOMO, fear of missing out. Oftentimes we're making a little bit less than other people are because we have this extreme conservative strategy that makes it very difficult to lose. And we'll look at why it's so hard to lose with our program. And then the next thing is that we're not actually trying to beat the market. In 10 years of doing this and representing every big name out there, what I found was that all those so-called gurus, they all thought to provide value to the market, they actually had to outperform the market, which I'm sure you guys know is extremely hard to do. And over the long run, almost no one can do it. That's why so many hedge funds shut down in 2018. The SPY ETF has become the biggest fund in the world, bigger than Ray Dalio's. There's famous bets between Warren Buffett and the hedge fund community that they couldn't outperform the SPY. Everybody who took his bet lost. And so our product is actually really focused around trading the SPY ETF and taking advantage of its options market. So it's unique in that it has 3 option expirations a week. Everything else out there only has 1, and some securities only have monthly. And so you'll see how we can take advantage of that to generate a consistent return while protecting the capital. And so we'll jump into that. We have a couple of portfolios that our clients follow. During the free trial, you get to see our Monday, Wednesday, Friday program, which is the most popular. SPY ETF is really America's most important security. It trades $16 billion a day. Its option market is extremely liquid, and it's really the key investment of most funds around the world. So it has a huge demand. Now, in our product, we're taking advantage of 2 things. Number one, we're selling call options against the asset, which we relate to something like owning an apartment in New York City, and people want to rent it out from you. And so if you had an apartment in New York City and then you got the Airbnb app, you could be renting it out 3 times a week. And so for 100 shares, we can make anywhere from $50 to $100 per trading period. And there's 3 trading periods a week. And there's 52 weeks in a year. So that's somewhere around $7,000 to $15,000 of income just simply from selling call options against the SPY. So that's really the most popular part of our program, but it's not everything. And so I do want to quickly touch on some of the other parts of our strategy that you'll get when you upgrade. So when you first start off, our goal is to really give you the most popular trade that has the most consistency and the juiciest income from selling call options. And that's that SPY play that you guys are getting during your free trial. And that's what you'll even see after your free trial has expired. You'll still get to see that, just delayed after the market closes. But this portfolio, which is delivered on Thursdays, plays the bond market. And so what I really recommend most investors do is to have half their portfolio in the SPY and the other half in the TLT, which is the 20-year treasury market. Now, when you do that, it makes it very hard to lose. In general, when the TLT goes up, the SPY goes down. When the SPY goes down, the TLT goes up. Together, they tend to go up over the last decade. And so that makes it extremely hard to have a losing month. And so we'll jump into some of the trade alerts. The Thursday portfolio has done incredibly well over the last several weeks. And that is a piece of the puzzle that you get when you do end up upgrading. So the other piece of the puzzle is the buy and hold portfolio. Because the central banks are all racing to zero rates to try to offset the global slowdown that's been caused by the U.S. putting pressure on China to have fair business practices, we've seen this portfolio really rocket. So we do have a small buy and hold portfolio that focuses on precious metals and cryptocurrencies. Now, this one was really up 220% year to date, but we recently recommended doubling down. So we went from a 5% allocation and went up to a 10%. So this is currently a little short, but I've been letting it hit its goals just by going up in value. So we'll take a look at everything. And the last piece of the puzzle that we do offer is an alternative to the SPY ETF. So if you don't want to trade Monday, Wednesday, Friday, for some folks that's a little too much work, we do have an alternative weekly trade on Tuesday. And that trade typically will look at the biggest positions in the SPY ETF, and it will go for a higher return by picking a specific security. So we'll take a look at all of this in a moment, but let's start off by looking at kind of the flow of our Monday, Wednesday, Friday trade. This is the most popular program we have, and it's very easy to replicate. I'm just going to open up several of the last few issues that were delivered for this program, and so you can get a feel for how the trade looks. Okay, so at the bottom of each email, I will spell out for you the profit or loss we've made over a given trading period. And so this is the trade that was published on August 7th. So this was yesterday. And we can see what the SPY had done. It jumped from 288 down to 282.50, and then rocketed back up to 286.50, and then back down to 280. So the market's been very volatile. And so in this case, if you were a buy and hold investor just holding the SPY, we had a 10-cent profit, even though the SPY went down, which is interesting to see that this strategy can pull a profit in a down move in the SPY. And so what happened was Friday, Trump came out. We were very bullish going into last week, betting up on the SPY. And then all of a sudden, Trump came out and said he's going to raise tariffs on China. By Sunday night, the Chinese let their currency drop against the dollar. And this created a whole lot of uncertainty in the market. And so you'll see over the last few trading periods, even though the SPY lost a lot of value, our little boring strategy was still creating profits. So in this example, the SPY had dropped $1.34, but because we had a caller, which we'll look at, we sold a call option above the, and we bought a put option. We made a $1.97 profit on the caller, and walked away with a 10-cent profit, which is nothing to brag about. But earlier in the day, because we had our put options, we were actually up a lot more. And so you'll see with our setup, the SPY can go crashing down, and it really won't matter. We're completely protected. Now, if I go to the next trade, this was on August 5th, so that's the Monday, and this was the big drop. This is where a lot of people probably had some pain in their portfolio. This is what the SPY looked like that day. And again, we had to transition from being very bullish because the Fed was dropping rates, earnings were hot. It looked like Trump was going to push the trade war to after the election, and then he switched his mind up. So we switched our trade. And here's an example where over the weekend, the SPY had dropped $4.86.
Biggest day, down day of the year too, Jason. That's important to note.
Yeah. So some people were losing a lot of money during this period, $4.86 a share. We walked away with a nice clean $1.32 profit. And that's because we sold the call option for $3. And the person who bought that call option, he lost about 98% of his money. So we were able to keep that $2.97. But what really saved the day was we had a put option underneath our asset. And you'll see that's really our big secret. We're selling the call option, which I kind of equate to either renting out your property like the hotel or the apartment in New York using the Airbnb app. And then we're buying insurance. So we're using part of the rent we collect to buy insurance in case something bad ever happens. And in this case, something bad did happen. And our $1.83 we invested into the put option turned into a $5.04 credit for a profit of $3.21. So we walked away with $1.32 even when the market was traveling down. I'll go back to the next trade. We'll look at these setups so you can see exactly how it works. Here's the trade from July 31st. So this is last Wednesday. And our headline was the Fed's making it rain. We were expecting them to drop interest rates, which they did. Of course, that was all ruined by Trump raising the tariffs. So here's an example where the SPY lost 13 cents in value. It basically had traded flat from Monday through Wednesday. Our call option that we sold was a 32-cent credit, but we had to pay 10 cents back, giving us a 21-cent profit on the short call option. But we had still bought crash insurance. We'd paid 30 cents for that, and we were able to get 10 cents back. So we don't win all the time. Here's an example of a 12-cent loss. And again, every update you're going to get, we're going to spill it out. We're going to tell you how many, it's going to usually be between 50 cents to $2 that we've won or lost. Sometimes we break even like this one approximately. But every trade alert, you're going to get this summary so you can see exactly what happened to the underlying asset, what happened to the call option we've sold, and what's happened to the crash insurance we've purchased. Okay, so I'll go back another trade. So now we're looking at the 29th. So this is the Monday. And it says, collect big bucks this week owning the SPY ETF ahead of the Fed announcement to cut rates. So we were predicting that they would cut rates, which they did end up doing. Let's see what our profit loss was on this one. Okay, so we had another flat one. And again, we don't hide it from you. Every trade alert, you'll see this exact summary. The SPY was basically flat. We made a little bit of profit from selling the call option, and that was used to finance our insurance. And the insurance really pays off when the market gets volatile. Here's another trade back. So now it's from Friday over the weekend. We can come down and see the summary. And we made $1.38. So the SPY traveled from 300 to 301.48 for a $1.48 profit. And again, you guys have access to all these trade alerts, so you can go see the screenshots. You can go through it with a fine comb if you like. Call option went from an 11-cent credit to a 1-cent debit for a 10-cent profit. Our crash insurance, we paid 20 cents. It expired worthless. And the SPY, in this case, delivered the $1.38 profit. Okay, and we'll look at these trade setups once I get through it. Okay, now we're going back to the 24th. So now we're looking at 2 weeks ago on a Wednesday. What kind of profit did we make? We made $1.60 a share. Here's how we did it. SPY went from $297.29 to $300 for a $271 profit on the underlying asset. The call option that we sold initially brought in a 34-cent credit. We had to get out of it for a loss. That's okay. We paid $1.06. We lost 72 cents on that. The put option went from a 39-cent debit. That was our insurance. We lost 39 cents on that, but we still walked away with the $1.60. So we'll go back another period. Oh, and this was just this is where we told everyone to double down on your buy and hold crypto portfolio. So, okay, so that's just the last, what is that? 1, 2, 3, 4, 5, 6, 7 trade alerts. So you can see kind of the typical return and risk reward. Let's look at some of these trade setups now so you get a feel for how we do this and how it all works. And again, this is just one piece of the puzzle. If you really want to bulletproof your portfolio, it's important that you follow the Thursday trade alert as well. Because like I said, usually if the TLT goes up, the SPY goes down. The SPY goes down, the TLT goes up. And by doing those together, it's extremely hard to have a losing period of time. So let's look at it. So here's our typical trade setup. We're going to start off by buying 100 shares of the SPY ETF. Why the SPY ETF? I would argue it's the most important security in the world. It's really what drives the bond market. It represents 504 of America's top most profitable public companies. And they're automatically readjusting how much of your money gets invested into each of these 504 companies. The expense ratio is super cheap. The SPY ETF really is why mutual funds and hedge funds are slowly going out of business. Why go pay a ton of fees and commissions and all kinds of junk when you can just buy the SPY ETF? And so what I tell people is it's kind of like we found that really hot girlfriend you had back in high school that was just too wild to get married to. That's kind of what the SPY ETF is like. We put this strategy on top of it, and now we've tamed it down. We've tamed it down. We know the general move of the SPY is going to be up as long as interest rates are low and earnings are high. And so we can take out the volatility by putting on what we call a collar. So we buy 100 shares of the SPY. We sell a call option. So I equate this to something like taking candy from a baby, or if you like the real estate model, it's a lot like you own an apartment in a skyscraper in New York City and you're renting it out for income. And so we sell the call option and then we buy a put option. And so this creates a scenario where we can only win or lose a very small defined amount of money. And in this case, in this example, we could win up to $3 a share. But in the bad case, if the market crashes for any reason, which at this point is as simple as Trump scaring people with tariffs, we have insurance. So the worst price we can get for our shares is $297, and the best price we can get is $303. So when you do this, it makes it very hard to lose very much money. Here's the next trade. Same setup. We buy 100 shares of the SPY. We sold the 302.50 call to generate income, and then we put part of that income to buy insurance. So in this trade setup, we could potentially make $1.91 a share, but our maximum loss over this trading period would be $1.09. Go to the next trade. Very similar setup. Buy 100 shares of the SPY, sell the call option, buy the put. In this setup, we could win as much as $4.30, or rather $2.67, and our maximum risk was $4.33. So depending on what Wall Street's doing, we may or may not take on a little extra or a little less risk. Now you're going to see that leading up to Friday, we were selling the call option above the trading price and buying the put option below. So that helps us make money if the market goes flat or up. But when we think the market's going to go down, you'll see there's a slight tweak, and that's how we're able to make money when everyone else was getting hammered earlier this week. Okay, so here's another trade, same setup. Again, this is going into strong earnings. Everybody was worried about earnings. They came out strong. There was no threat of the trade war escalating, and the Fed was expected to lower interest rates. So we were very bullish on the SPY leading into this period of time. Go to the next trade alert. Okay, this is the Friday trade, and you can see we flipped it all. That's because we were worried that Trump was going to escalate, China was going to fight back, and now all of a sudden we're doing the opposite. So you can see the last trading price on this was 286.78. Well, we sold a call option below that, and we bought a put option above. So let's just compare these two trade setups so you can see the difference. So if we're bullish, if we think the market can go flat or higher, our standard trade will be to sell a call option above the trading price. So you can see the last trading price was 301.10. I sold it at 304. So that means I'm willing to sell my shares of SPY for $304. That means I can make about a $3 profit on that. Plus, I get to keep this 53 cents that I collected to give the call option buyer this right. Now, what did I do with the credit? Well, I was already standing to make $3 if the SPY went higher. So I used most of that credit to protect the downside. So on the other side of the trade, I'm willing to buy the 296 put for 41 cents. So on the upside, if the SPY goes higher, which it normally does, I get to keep all the profits up to 304. But if it goes much lower, I'm protected. And so those don't typically pay off very often, but you don't buy insurance to get rich. You buy it to protect yourself from unlikely events, which happened to happen over this trading period. Okay, so in this trade, we did a little different. We sold the in-the-money covered call for a huge premium, $297. And then we bought a really expensive put option for $236. So that's how we were able to walk away with a nice profit on these trades.
And does anyone have any questions as Jason's walking through that? And if you do, please feel free to reach out if you do. We're more than happy to help. This is a great time to do it, folks.
Let's see, I've got some other stuff posted in here.
I do. I asked some on the right.
Yeah, okay, so you posted your question in the chat box?
Yes. This is David Goldsmith from Los Angeles. I've traded phone calls with you. I'm interested in your program and how you've developed the system. I asked a couple of questions on the right, but I also like to know, are we basically buying into your algorithms or technology system that analyzes this stuff behind the scenes and then makes recommendations based on your analytics?
Sure. So yeah, I mean, really this product revolves around predicting three markets. The most important market to predict is really the bond market. So my key interest is trying to predict whether old Fed Powell is going to raise rates or lower rates. So clearly, if he's raising rates, that's going to be bearish on pretty much everything, which is what we saw in 2018. And so that revolves around really predicting inflation. and also following the Bank of China and the ECB. So from what the Fed's doing, we have a pretty good idea of where the general market should travel. So really it all starts off understanding the bond market, which is what we trade on Thursday. And so I'm not trying to guess what's going to happen in a small trading window. If you've ever read the book Random Walk, I'm a total believer in that. It's very hard to predict random pieces of news from where we stand. But what we can do is get the big picture right. And so if we have the big picture correct, we can put on a trade setup just like I've shown you here and just repeat it over and over and over again and have a high probability of winning. And when we're wrong, we're not going to get killed because we have those put options. So this is not some sort of crazy technical analysis at all. Now I do look at where Wall Street puts its bets. So I'll look primarily at the open interest. I'm mostly interested in where the big money is writing options. So here's the option chart or the option chain. The open interest gives you a good hint at where people are willing to buy or sell the shares of SPY. So if there's a huge open interest in the put option market, that's probably a pretty good level to buy our put at, because there's a lot of people who are willing to convert dollars into SPY shares at that level. And on the other hand, if there's a huge open interest in the call option, we're probably not going to go much beyond that because the big holders of the SPY are willing to sell at that price. So really, we're just trying to tag along with the market, get the big macro view correct, and then tame it down by owning put options below our underlying assets. As far as the frequency of the trades and the duration, you'll see it's almost always the next trading period. So if I am going to get into the trade on a Monday, it's going to expire on a Wednesday. Wednesday expires Friday. Friday expires the next Monday.
And David, just to piggyback on Jason's response there, Jason watches the market ferociously 6 days a week, 18 hours a day. He monitors, 30 to 35 news publication sites, Jay? And that's between that and what the options market is writing. That's really going to help determine how we position and why, David. And Jason's kind of a mathematical savant. He's not too forward with telling people that, but I will absolutely openly tell you that. So just to kind of give you some.
That's one of the reasons I'm here. I'm a day trader. I also invest in Bitcoin and blockchain technologies as an investor. So this program might work for me. There's thousands of programs out there to choose from. And I guess the couple of questions I have, is this based on a system that is based on technology, data, analytics, or is it based on Chris's seat of the pan, sort of day-to-day recommendations?
Yeah, no, so David, here's kind of my outlook on how so we're basically picking up or down on the equity market with our trade setup, and we're picking up or down on the bond market with our setup. And then we're adjusting for inflation risk with the precious metals. So I'll just tell you kind of my big view and how that might change. So as far as predicting up or down in equities, with low interest rates and strong earnings, I'm going to bet up on equities. So I'll give us a position that makes money if the market goes flat or higher. Now, what scares me from the equities? Okay, trade war. Trade war could clearly create a scare. So we definitely have a tug and pull in the equities market that's pretty hard to predict right now because of this. We have strong earnings. We have a Fed that's expected to not just drop interest rates a little bit, they're expected to drop interest rates a lot. Okay, so I want to be bullish on equities during that type of scenario. And And so
Yeah.
only when there is major fears in the market will I, for a short period of time, flip the trade. And so we got that. Friday, we got the scare. We flipped the trade, and it paid off. Everybody else took a pretty nasty hit. We made a boring, $1.30 a share and then 10 cents. So that's the kind of perspective on that. The bond market, the same thing. If I see all the other central banks are dropping rates, which we just had India, New Zealand, we had 3 central banks that were not expected to drop rates this week, just 48 hours ago. So we can get a pretty good cue on the projected interest rates of the bond market by looking at what all the other central banks are doing. And so we're also bullish on the bond market. Now, funny enough, if the trade war were to come to terms, that could be very bearish for all of this, because now the bond market's overpriced, and it's going to start having to reprice that there's no trade war escalating. Now, the good news is probably the trade war is not going to de-escalate anytime soon. So it makes our predictions pretty long lasting. So I'm pretty set that we will be doing a very similar trade setup for the next 12 to 24 months, which is bullish on the bonds. And depending on how much the escalation happens between US and China, we can play the stocks.
So just to be clear, you're making recommendations 3 times a week, basically to do selling call option on the SPY and buying put options on the SPY, and that happens 3 times a week through the portfolio that you through your program.
Correct. Yeah, and 90% of the time we're in a position to generate a profit if the market's flat or up. So very rarely will I point the trade setup to profit from a down move.
Okay, good. And the last question is, how do I make $100 per trading session, which is 3 times a week in your example? How much money do I need to have at risk to do $100 a week?
Okay, so $300 a week would be what you could generate if you're averaging $100.
Yeah.
Now, we're not trying to average $100 a trade. We have, you just saw, we have had in the past 5 trading periods, $1.30. We've had a 10-cent gain. We've had a minus 15-cent return. So I would say really the average is if we can pull $75 to $100 of income a week, we're looking at around a potential 25% annual return. And that's still a little higher than I'm trying to pull off. So our real goal here is around a 1% return per month with extremely low risk. So yeah, your cost to play is $30K.
$30K to have in the market?
You have to have 100 shares of the SPY.
Oh, I see.
So that portfolio year-to-date return is 10.6, and it's had extremely, extremely low drawdown. I'm actually going to have this up for next week, the month-by-month return of each portfolio, and then also the combination of them. And you'll see once you combine the bond portfolio with the equity portfolio, we've had no losing months.
Yeah, so just to be clear, I have to buy 100 shares of the SPY to be in the game?
Correct. And if you really want to follow our, when you upgrade, you'll get a 30-day trial to our Thursday play. I really recommend you have 100 shares of the SPY and then 200 shares of the TLT. And that's going to really, really protect and bulletproof your portfolio from having drawdown. But if you just want to play the SPY, you would need $30K.
Okay. No, I want to play the straddle that you're doing, which is selling calls and buying puts. Right?
Yep.
That's your system.
That is it. We call it the atomic bomb-proof trade because, if all hell broke loose, we still get the price tag of whatever the put option was.
Okay, and the buy-in for that does that include TLT And so what's the total buy-in?
Yeah, really you need 70 grand to really, $66,000 would really accurately follow my total strategy. So
Good.
you'd have 30 grand following the SPY, 30 grand following the TLT, and then you'd plop 6,000 into buy and hold for precious metals. Let me show you guys how I have the precious metals allocated. So it's real simple at this point. For the buy and hold portfolio, you want to have, if you're following our recommendation, around 1/3. So you'd put, if you're doing this with 66K, you put 30 grand into the SPY, 30 grand into the TLT, and then you take 6,000 and you'd buy and hold these assets. Now you could skip the altcoins right now and just have essentially 1/3 in GLD, 1/3 in the minor ETFs, and then 1/3 in Bitcoin. So you'd have 2,000 in Bitcoin, $1,000 in SIL, $1,000 in GDX, and then another 2,000 in GLD. And this is the expectation that the trade war will escalate. The central banks will lower rates close to zero or negative, depending on where you are, and that the Fed is going to have to step in and start buying up government debt because our deficit is just exploding.
And,
do you have to have precious metals to do your program? I'm only interested in the puts and calls.
Yeah, you can skip the precious metals. So here's...
I got plenty of Bitcoin that I'm losing money on.
Yeah, so you're already, you can basically... What I'm providing for investors is when to get out of Bitcoin and when to rotate from Bitcoin into altcoins. So I think I can do a very good job of telling you, all right, Bitcoin's now overbought. The next run is in Ethereum, which has plenty of room to go. Okay, so I got a question. I've got two questions here, and these are great questions. So one person asked, if you put 66K in, what has the return this year been? The answer is 14%. So for every dollar, you made 14 cents. So I can calculate that for you. And what I want to, so that'd be
9,240.
Yeah, you made $9,000 this year. But what's important, guys, the return relative to the risk. Okay, people can make great returns swing trading, buying these different products, but they're having huge drawdown periods, 3%, 5%. Just in December and May, since we've launched this, equities have had some tremendous swings up and down. Our portfolio has not had any kind of swing like that. If we lose 50 cents in a trading period, that's probably one of our worst trading periods we've had. And that's times 100. So, if we lose $50 in a 3-day period, that's a terrible period for us. But on the other hand, we're just trying to accumulate paydays of around 50 cents to $2 per share over and over and over again. And we do that by getting the big macro picture right. Not trying to predict short-term swings left and right. It's a random walk. I don't pretend like we have some magic crystal ball. But if you get the big picture right, you position yourself to benefit from that, and then you put the put option below your assets, you cannot lose a lot. Okay, Gerald has a question. This is a key point that's not obvious to a newbie. The calls expired 2 business days later. Okay, so yeah, let's look at how those, a lot of people wonder how you get in and out. Let's just look at one of our big winners so you can see how you get in and out. And let's do it on a standard play, because very rarely do I want to bet down when earnings are strong. Money's flooding to the US because they can't invest it anywhere else. So let's look at this is our 9 out of 10 times. This will be your trade setup. Okay, Ernest says, is the 100 share SPY requirement a margin requirement or just part of strategy? Yeah, a lot of people want to try to get around owning the SPY by buying a call. But the problem is now you're paying for that premium, the time premium. So we don't want to do that. And the way we do this, you cannot lose a lot of money because we always have a put option right below the trading price. So let's look at this trade. Here's a good win, not our best win, but this is a better than normal win. Let's just look at exactly how we made the profit in this particular trade. So I got to go back one trade earlier to see it, and we'll look at how we closed it. So step A is always going to teach you how to close out your trade. Let's see the trade we put on. Okay, so here was the trade, and let's look at the date. This was July 24th. And then we got out of the trade July 26th. Okay, so here's the important things to look at. And if you guys want to paper trade this, or make sure this is working on your own side, don't trust our content, do it yourself. Here's how you do it. So first thing you gotta do is keep track of what was the last trading price going into the play. Okay, so in this example, you can see the screenshot, $299.90. Okay, so what did we do? We sold the 303 call for 10 cents. That's nothing. So if I go sell a call option for 10 cents, that means we think the SPY is going to go up all on its own. And that's the easiest money there is. So we took 10 cents and we actually paid a little extra for some protection. So we paid 21 cents to buy that put. So Trump comes out an hour after we do this pick, says, hey, we're going to war with China. Stocks dump $10. It doesn't matter. We have the put, and it is $2.90 below. So we know our maximum loss going into this play. Okay, so we sold the 10-cent call, and we bought the 21-cent put. So this setup essentially says we think the SPY will travel higher, and we don't want to miss out on the gains of the SPY by selling too close of a call option. So this is a very bullish play. Let's see how we get out of this trade. So the SPY did go up, and here's how we get out. So we can see the SPY was trading at $299.90. The next trading period, when we wanted to get out, it had gone up to $301.16. Okay, now that was nowhere near that 303, so the guy who bought the call option lost his money. We have to close it out. We could let that expire worthless, but guess what? Then we're going to miss out on the rent we can collect from our asset between this period and the next. So we always have to buy to close the call. Now the put option went to a value of a penny. You cannot sell a put option that's only worth a penny. So that part of the play we let expire worthless, but we did have to buy to close the call. So that will happen every trading period. So we have to, here's kind of your mechanics. You're going to sell to open the call, and you're going to buy to open the put. Okay, so that's the setup. That will always be the setup. That's what makes this program so safe. And that's what allows me to, with good conscience, tell people you do not have to look at your trading account except for 5 minutes, Monday, Wednesday, Friday at noon Eastern, because we have complete protection, not partial protection, not, hey, you got to rush to your computer at the close because we're down big protection. We have passive protection at all times. Now, we got a bunch of millionaires following this, call it the peanut gallery. They've been pissing and moaning about losing money, part of the profit on the puts all year. All year I had the peanut gallery giving me the hardest time about it. And then guess what? We saved them probably about $10 a share over this week. And now they're all glad they had their protection. So if we can finance our insurance by selling an out-of-the-money call, that's great. So if I think stocks are going up, you'll have a wide collar. This is a wide collar. Now, if I think stocks are going flat, we can push that strike much closer to the trading price. And that's where you get that juicy $1 to $1.50 option premium. So you'll see, we adjust the width of the collar on the market conditions. And so that's really where my specialty can come into play. But, going back to the question of the gentleman earlier, I'm not trying to second guess the random walks of the market. I'm looking at the big picture. What's the big macro picture look like? And then we're going to repeat the same play with slight alterations over and over and over again. And so if you get the big picture right, you can kind of just not look at all the noise and consistently generate profits with a very high win rate. And really what we're more concerned about is losing a lot. If we can avoid losing a lot of money and just sit there and consistently win, that's how you can generate a very nice return with very low risk. So we got a new question. Is there a chance of SPY shares being called away from you? Yep. We love it when we get assigned. It's been hard to get assigned this year, but that means you're going to walk away with the maximum profit. Okay, Gerald says, so when you close out the trade on the 24th, what was done on the 26th? Okay, so we're on the 24th trade. So we closed out this, buy to close. That gets us out of our obligation to sell our call option or our SPY shares. So on the same date, we open the new trade. So here is the new trade. So first we have to get out of the last trading period's caller. So if the call option, we always have to buy back, even if it's only worth a penny. The put option, we can let go. Okay, and if we get assigned, for your question, JD Myers, that's the best thing ever. That means we get the maximum profit and we're in cash. So I would much rather be in cash and get my premium plus the spread on the difference of where we sold the call, and then just wait for the next trading period. So if you do get assigned, don't do anything. You're going to be in cash the next day. You're going to get to keep the option premium, and the person who exercised the call option has to pay you the agreed price, which is going to be a guaranteed profit. In fact, it's our maximum profit. So then you sit back, you wait for the next trading period. Don't buy the SPY without the caller. Okay? If you want to be a risky investor who's going for growth, that's who should buy and hold these different products. And it's not a bad strategy either, but our audience is much more about trying to define their risk and take advantage of the option market so that you almost have no chance of losing, especially when you have half your portfolio in the TLT and half of it in the SPY. So every period it's very similar. We close out the caller and then we open a new caller. So if you think of the analogy that you have a very popular apartment in New York City, and you can use the Airbnb app to rent it out 3 times a week for a high level of income, that's kind of what this is like. So this is just the example over the last 5 trading periods of how we trade the SPY. Let's take a look at some of our other trades. So I'll go to the different category. So Tuesday trade will take a little more risk and go for a bigger return. And so it also is a little more passive. So if you don't want to trade 3 times a week, this is a good alternative to the SPY. And some people like to do both. We have a lot of people who are happy to trade 5 minutes a day, Monday through Friday. And that's where these trades are organized right here. And so I'll pull up some of these just so you can see some of the profits we've had in here. you're going to see it's very similar trade setup. But I am doing a little more work on these ones. See, we got some. Oh, we got Sue. Hey, Sue, I saw you joined, and Dan and Howard, Jeff Woods, Stephen Marquez. Sue, do you got your audio? I unmuted you in case you wanted to say hello. This is our Thursday trade. So I'm just going to open up a handful of these ones so you can see how we've been trading some of the other portfolios. Now our bond portfolio has been doing quite well. This one will from time to time rotate into Google and Amazon when they're selling at a huge discount, but most of the time it is simply trading the TLT. And I've, over the last several weeks, because some people have a hard time understanding how these trades work because there's several pieces. There's the underlying asset, there's the short call, and there's the put. So I've only recently been able to start putting this little summary at the bottom that really spells it out for everybody, which has proven to be very beneficial.
Yeah, I was trying to find out if I had filled out all the paperwork for my kid. She was in the Bunheiser, and now she's going to be coming over there. And that was one question. The other question was on the website. I'm trying to go over there and I guess pay for the Chrome book, but I don't see where it tells you to purchase the book. It tells me to purchase the insurance. Oh,
I'm sorry, can you say that again?
One time $35. I thought it was like, okay. Oh, okay, because some other parent told me that they actually bought the book and they bought the insurance, so that's why I was confused, Okay, so then is there a charge by doing using a charge credit card, or it's the same thing?
I'm not sure if he's talking to us or not. I'll just mute that for now. Sorry, guys. Okay, I'm going to pull up the last 3 bond market trades, and then we'll look at those. Okay, so here's the last several weeks. Now again, this is only trading on Thursday, and it will not touch these trades except for Thursday. Now that doesn't mean we couldn't goose more profits out of it by micromanaging it. But again, this is not a day trading program, and that would really reduce the amount of people who could benefit from this product. So it really just is very strict that it will only touch the portfolio on Thursday at noon for this part of the asset allocation. And so that allows you to have a nice retirement and not have to be, day trading or swing trading or anything of that nature. So we'll look at the trade summaries over this period, or last 3 weeks. Okay, so we've gone back 3 weeks. So the first week we had lost 15 cents. You can see it in the summary. This is what's text message to members. So a lot of people do like to be able to get the text message, do the trade, watch a video later. And so that's what this trade summary will do. And here's what your typical trade summary will look like. So we had to buy to close the call and sell to close the put. So we got a little money out of the put, and we had to pay a little bit of money back to get out of the call. So overall, that was a credit of a penny. And again, on this trade, we lost 15 cents a share. This is how we got out of our gold trade. So we've been playing a very similar bet, and it's just now starting to really pay off because of our macro view is starting to wiggle its way into the bond market. The next trade was, again, we can look at the last trading price. Now, TLT climbed all the way to 140. So we did miss out on some of that upside because of our conservative strategy. But you can see I sold a juicy, right at the money call option. So we took in 74 cents. And we agreed to sell our shares for $131.50. Now that was, at the time, 38 cents more than it was worth. So we entered the trade when the price of the TLT was $131.12. We agreed to sell our shares for $131.50. And if it were to jump way above that, we'd still get to keep the 74 cents we collected. Now we did reinvest part of our credit on downside protection. The TLT were to sell off violently, it wouldn't matter. We would walk away with $129 a share in the worst case scenario. Plus, what happens to call options if the underlying asset goes down? Call option loses value. So we get to keep the 74 cents. We lose the 29 cents, and we get to sell our shares for $129. So you can see the risk reward setup right here. In this trade setup, we were potentially making 83 cents a share, and our maximum risk was $1.67. Now, the TLT could go down, and we break even to the point of 131.56. And if it went up just a little bit, we'd hit our maximum profit. So again, this is our typical trade setup if we think the asset will go flat or up. Here was the chart of the TLT. And again, this is before it broke out to 140. 2 was the high. Now we're taking a part of the profit of the TLT spread or credit, and we're investing it in a bull call spread on GLD. So this has been a very repetitive trade. You'll see all of these trades are almost identical. And essentially, as long as we think the US trade war is going to escalate, this will continue to put a damper on global growth, which is going to cause all the central banks to keep lowering rates and funding their own governments, as they all have become super hungry for having huge deficits. And so as long as that's the case, we're going to be bullish on bond prices going up and gold market going higher. So we took the little credit that we made from that trade, and we invested it in the bull call spread on GLD. So we've been doing this last month, this month. Today's trade alert actually was exactly like this, which we'll look at in a minute. And so this setup essentially says if GLD goes up, we're going to double that credit. So you can see our maximum risk was $23, maximum profit was 26. So we're putting on one of these trades relative to every 100 shares of TLT. So it's not a huge risk, and it's not a huge profit. It's just something we can do to increase the potential profit over the long term of doing this week over week over week, as long as our macro view remains intact. And with the news over the weekend, it certainly would appear that tariffs will rise September 1st. Chinese will continue to take the punches, and it looks like they're now actually putting their gloves up. So it's been more of a Chinese are playing the card that they're being unfairly punished. Now they're actually starting to fight back a little bit. So things look like they're going to escalate. And if that's the case, TLT and GLD have a long way to travel higher. Okay, so that was the setup. Again, we'd had this the previous week. We lost 15 cents. Let's see how this trade setup worked out. And we'll see how we get in and out of the trade, just so you know what the motion looks like in terms of the trade. So here was the entry. Right here. Okay, so we go to the next trading period. We made $1.09 per share. That's because the TLT shot up from 131 to 134, $3 gain. We missed out on some of the profit. We had to pay back $1.86 to the caller, which was our protection. And GLD lost 7 cents on that one. Now you can see in the next trade, the GLD doubled up. Let's look at how we got out of this trade. So to start the trade, we sold the call and we bought the put. To get out, we had to buy the call and sell the put. So I'll just flip back and forth so you can see that. Sell to open, buy to open. To get out, we buy to close and sell to close. Okay, and you can see the TLT popped right there. Continued to pop into the next period. We had to sell back our GLD. So sell to close, buy to close. A little bit different. This is a bull call spread where the other is a caller. And again, this does not have to do with owning any shares of GLD. This is just relative to how many callers we're doing on the TLT. The goal is to just, if we get the TLT call right, GLD should go up as well. And that helps us get a little extra profit without a lot of extra risk. Okay, let's look at the new trade. So here's the new trade setup for this period. We sold the call option above the trading price and we bought the put below. Gave us a credit of 22 cents. We reinvested that into the same play we just looked at. This time it actually paid off. So we sold, we bought the 132.50 call and then we sold the 133 call. So we're just buying a call option that's worth a little bit more than the one we're selling. And so the risk reward on this is we could have made 21 and we could have lost 28. So let's see what happened. So today we hit one of our bigger wins on the TLT. We made $1.70. Again, we missed out on some of the upside, but we had absolute protection. The TLT gained 487. We lost 338 on the caller. And our GLD bull call started off with a 29-cent debit, but paid off a 50-cent credit. So let's look at how we got out of that trade. We had to buy to close. I'll go back to this trade. So we had to buy to close the August 9th, 2019, 135.50, which you can see right here. And because the put option went to a value of 0 or 1 cent, we could not sell it, so we just let that expire worthless. So that's how we got out of that. Next part is to get out of the bull call spread on GLD. So I'll go to that new trade right here. Buy to open, sell to open. To get out of that, we just sell to close and buy to close. So you can see we paid a debit of 29 cents to get in, and we got our max profit to pull out a credit of 50 cents. So what was the new trade that we're in now? Same setup. We sold the call about $1 above. So we get potential profit of $1.83 if the TLT shoots up even higher. On the downside, we're protected. The worst case is we can sell our TLT for $137 because we bought that put. And here's our profit loss ratio. It's about even on this one. So TLT could go down a little bit and we break even. If it goes up a little bit, we make a maximum profit of $1.52 per share. And if the TLT were to have a shock and have a sudden sell-off, worst case is we lose $1.47. Any question on how these work? You can see it's almost identical to the SPY setup. There are different circumstances where we might change our view of what the underlying asset should do. And so if we thought the bond market was headed lower, we can flip that trade to do the opposite of this. So we would simply move the strike of the call below the trading price and the strike of the put above, and you basically will flip this little chart up. So I'll demo that because I think I still have this actually open. Okay, so here's our current trade for the bond market. But let's say we thought rates were going to travel higher. So let's say the US-China trade war made a truce. Chinese agreed to a deal. Trump's happy. Now there's no reason to be lowering rates. I mean, job market's strong. Earnings are strong. You know, if you didn't know there was a trade war going on, you'd think the Fed's crazy for lowering rates. So let's say they were planning to start to raise interest rates. How would we react? Well, super easy. And push this to 137, push this to 140, see what it does. Boom. So what's important is we can bet down on an asset with very little risk by owning it and flipping the collar upside down. If I try to buy a put option on the TLT and the TLT goes up, we're going to lose 10, 20, 50, 100% of that put option quick. Okay, but what happens if I do this trade and I'm wrong? Well, first of all, my maximum loss is only $1.37. Okay, and that's relative to a $14,000 investment. So that's maximum loss on this is about 1% week over week. But here's what could happen. Let's say TLT were to rocket higher for half the week and then crash the other half of the week. What could happen? Well, let's just take a look at it. If I am agreeing to sell my shares of the TLT for $137, they're currently valued at $139.50. That's actually $2.50 less than they're currently valued. So why would I even go into that contract? Well, it's because the option buyer, the call option buyer, is willing to pay $392 for that right. So he starts to make money the second the TLT hits 141. Let's just say today some scare happens. Let's say we're betting down on the bond market. All of a sudden TLT flies up to 144, 142. Doesn't really matter. If it went to a profitable range, that call option buyer has the right to exercise his option contract. And for us, that's great. We get to pocket the difference. So we're agreeing to lose $2.50 on the TLT, but we get to gain the 4. So that's $1.50 profit. Now that's not quite going to pay off the put option we bought. So this is what can happen in this setup and why I really like this setup. It's if we ever get to a position where we can bet down on an asset, this trade setup can make more than this graph would indicate. And let me explain how. So we could have the TLT spike today and get assigned tomorrow, and we walk away with that $1.50 profit on the long side of our play. Okay, so we're now in cash. We got to keep the option premium. We made a small profit. Now we're still owning the long put option. Now let's say the TLT were to crash by next Thursday, all of a sudden that deep in the money 140 put is going up in value. So we can actually hit a win on the upside and then be long our put without the risk of the underlying asset depreciating. So it's hard to bet down. We don't do it very often, but there most likely will come a time where we can do this play and hit double paydays. So again, this is just not the current macro outlook I have, so we're not doing that. But that's how easy it is to make money in a down market safely with our program. All right, guys. Well, we've gone for about an hour. I'd like to open up for questions and let you guys know if you do want to upgrade so you get the Thursday play instead of just Monday, Wednesday, Friday. Call Dean. He does have some deals he can offer you. Are there any other questions out there?
Jason?
Yes.
Can you hear me?
Yes, sir.
I got in a little late. This is Howard. About tomorrow's trade on the SPY.
Yep.
We're the exercise, correct?
Yeah, we could be.
Because we're $4, you know, we're so far away, so deep in the money. What happens to that call we sold? Right now, if I would buy that back, it's over $600.
No, you don't want to. So getting assigned is
I'm just saying,
best case for us. So yeah, we want to get assigned and end up in cash. So this is a good example, actually, Howard, of what I was just talking about on the TLT. If we get assigned today, which we could, you get to keep that option premium and go to cash. So that's where you'll wake up in cash and you'll get to keep that premium we collected.
Okay, so that $600 goes away. I mean, if I was to make the mistake and buy it back today, that would cost me over $600. You're saying that that'll disappear tomorrow if I'm assigned.
Right, exactly. And the reason it costs $600 is because your asset has appreciated significantly.
Right.
So most likely you will be long your put on the SPY and be in cash. So you'll keep the option premium we sold and you'll have the more valuable put. So the best case scenario for us at this point is that we're assigned tomorrow morning and then have a little sell off and then get out of that put.
And so in tomorrow's alert, we're going to buy the SPY back?
Yep.
And then you'll tell us what to do as far as the selling the call. As far as the caller, you'll tell us, give us the new instructions. Huh?
You got it. Yeah, so it'll be very similar as all the other trades.
So what happened today? Why did the market go so wild?
To the upside?
Yes.
Yeah, sure. Let's talk about
that.
that.
Did that cut you off guard?
So I'll show you my notes in the Telegram chat. My expectation was that we would sell off from the bad news, which we did. And at that point, I'm going to be playing it the bearish side of this most likely till September. So I think there's more downside ahead for equities right now. But yeah, our setup, our goal is to get assigned and then catch a crash. So I'm looking for the Fed to put in the Fed put before we're going to be betting up on the equities.
Okay.
So yeah, the next thing that's most likely going to happen is more trade escalation. That's really what I'm looking at here. So I'm not ready to bet on a recovery yet. So I think the next strong safety point for us is right here, September 18th. That's when the next FOMC meeting is, and that's where they're expected to dramatically drop rates. So what caused people to have so much bullishness today? This is when we hit 143, that was essentially the bond market guaranteeing a big rate cut, which is what the equities market wants. They want to see that the Fed is going to cut rates make money cheap, and that supports the equities market. The problem is the market's so hypersensitive to the news that that I'm concerned with another tweet, this could go much lower. So our setup today, tomorrow will be probably very similar to Wednesday's. So we're currently, our maximum loss on the Wednesday trade was 60 cents, but our best profit is if we get assigned and then catch a dump. So we're going to be in cash. We get to keep that option premium. And if we're lucky, that put option will pay off tomorrow. But yeah, I don't think we're going to find a bottom in the equities until we get a little bit higher VIX spike, maybe more like 30. So if you look at some of these VIX spikes, you know, it spikes, it sells off a little bit, the volatility, and then it spikes even harder. So I'm afraid that I do not think the volatility is over for equities right now. And so I'll be reluctant to position ourselves to take a big loss if there is another volatility spike between now and that FOMC meeting. So, so yeah, expect a very similar setup. The good news is we're in cash tomorrow morning. We get to keep that option premium, and we're long the put. So if we get a down move, we can have a very nice gain from the put option, and then keep the profit from the short call on the SPY.
Okay.
Now, market stays higher. Our worst loss is 60 cents on that trade. And so yeah, just to reiterate, you know, when will we play defensively in equities? The best indicator of a stock crash is the start of a stock crash. Trying to predict it before it happens is a very difficult thing to pull off. So I'll wait for some bad news to hit and then switch us over to being defensive. So there will always be a period where we may lose a tiny bit when the market suddenly changes direction. But usually it's based on some news. So we had that news. Trump's raising the tariffs September 1st. China devalues their currency. So this is just getting started, and very skeptical this will travel back to the high before we get the Fed put. So the Fed put should come into play most likely right around here. Now, another interesting indicator people are using to try to predict a safe entry point into stocks is to look at Bitcoin. If Bitcoin were to really sell off, because, you know, what's the big driver of Bitcoin right now? This is a very easy to manipulate market. So the short-term moves of that can give us some indications in terms of whether there's fear in China of devaluation. So if they were to stop devaluing their currency, the fear of losing value for the rich Chinese would disappear, and we'd expect a pretty sharp sell-off in Bitcoin. So that would be a good indicator that we're getting to a relatively safe place in equities. And so we're seeing a little bit. They did, you know, let me see if I can I'll pull up a screenshot for you guys so we can talk about kind of predicting this, the big risk I'm looking at right now. I'm going to post it up in a second here. All right, so you want to know why stocks went up. It's because this conversion rate was slowed down. They let their conversion from dollars to the Chinese currency depreciate about 10%, exactly the amount of the tariffs. And it started to go way above 7, all the way to like 7.1. And if that were to continue, that would mean the trade war is going to really escalate. And so people became bullish on equities when they saw that rate stabilize, and when the Chinese Treasury said that they will maintain that level for now. So they're trying to offset the tariffs by devaluing their currency. And so we can look at some of the Trump tweets. So this is the main risk in the equities market. Trump came out and said, hey, we're going to raise tariffs 10%. China came back and they said, all right, we're going to completely stop all agricultural purchases, and we're going to devalue our currency 10%. Okay, so the US has not responded to that yet. So everybody who's long equities, you know, the big risk is that in 22 days, tariffs will rise on the remaining $350 billion of imports from China to US. That's going to be negative for equities. Okay, now what's going to save the day? Well, the big savior of all of this is that it's going to force the Fed to lower rates, lower and lower, to potentially start buying up US government debt, and that'll take pressure off the bond market and push more money into equities. So my concern is that this weekend even, potentially more pressures put on China. So that's what I'm really concerned about. So I'd like to see either the price of Bitcoin dramatically sell off. I would like to see the VIX hit something much higher. 24 was pretty good, but I think more like 30 would be a safer entry point to be bullish on equities. And I think specifically, we can just about count on the Fed's reaction on this point right here. So we've got about 40 total days between now and when the Fed will have its next FOMC meeting and most likely drop rates. So that's a pretty risky period of time. And you got to realize, Trump came out on a Friday saying he's going to raise tariffs. China came back and said, we're going to completely halt agricultural purchases. This is dramatic. This is targeting the farming base, which is important for his reelection. So there's no way Trump is happy about any of this. And so now we're just a sitting duck waiting for the next tweet where they've juiced up the trade rhetoric. So that's my big fear. So our setup in the SPY right now, let's look at the most recent trades. We'll look at that. And so the whole thing about the market is when it does sell off, it creates a lot of automated selling for the CTA funds, which is a huge amount of buying. It's these people these automated trading systems. And so this big rally is very impressive. I'm definitely impressed by the size of the rally. But we're in a trade setup where we can lose at most $106 or rather 94 cents a share, $94. So that's the most we can possibly lose on this current trade setup. So let's look at it. We entered this trade when the SPY was at 285.60. And we sold the 286 call for $2.47. So if we're assigned, we get to keep the 247 plus the 40 cents. We're making about 280 on that part of the trade. Now, where do we lose? We lose on that put. We bought a very valuable 288 put for 381. So best case for us at this point is we're assigned tomorrow, we're in cash, and then the SPY put tanks. So if we can lose less than $1 on that put, we'll actually walk away with a profit and have been completely protected to the downside. So I intend to do this very similar setup until we get the Fed to actually lower the rates. So we're not there yet. Fed Bullard came out this week. He's the most dovish of all the Fed people. He said that the rate is fine as is, and that it's completely normal for a trade war to have these little threats going back and forth. So there's still no sign. There's no, the Fed has created a habit of trying to tell us before the event what they're going to do by having all these speakers come out. So we haven't had anyone come out and say, yeah, we're going to drop the rates and apply the Fed put. So that's why I'm still, and I hate to bet down, guys. I absolutely hate to bet down because, number one, rest of the world's in trouble. So that's causing a huge flood of cash to both the U.S. equity and bond market. Two, earnings were great. Microsoft just had its best quarter of all time. Apple came out with better than expected earnings. Amazon was a little weak. But overall, most of the companies are having great earnings. The job economy, the job growth continues to grow in the U.S. So in general, I would like to be bullish equities. Okay, but there's just one catch, and that is I'm expecting the trade war to escalate between now and September 1st or around that period of time. So I think our big savior is going to be the next FOMC meeting, which is coming up, and we have 40 days to survive till that Fed put is back in place. Now, if the bond prices go to a certain height, that would almost guarantee those rate cuts. So I could see equities start to bounce and presume the rate cut. But with the sell-off in the TLT today, we're just nowhere near that point where we can count on the Fed to lower the rates and to start supporting the bond market, which would flood the cash into equities. So better to be safe than sorry right now. That's my outlook. We saw the sell-off. We saw the fundamental reason to be scared of equities. And is it going to pop up and down? Yeah. But my concern is that Trump made the threat. China totally fought back this time. This is the first time they've really put their their gloves up to fight back. So now they're saying they'll buy no agricultural products, and they devalued their currency. Trump is not happy about that at all. So I would suspect that there will be more aggressive tweets coming out in the near future. Let's see if we got any other questions out there, guys. We've been going for almost, let's see, quite a while now. Oh, let me unmute Dean, see if he's still there. He might be on the phone with folks right now. Oh, Howard, I see you had your hand raised. Did you get all your questions answered?
That was before you answered me.
Oh, okay, great. So yeah, the rally's been very impressive. Perhaps the rates got priced in that we might have a little bit of a rate cut, and that's why we saw that bounce. We saw the Chinese start to protect their currency, which is important to show signs of the Chinese not completely going to war with us. But I'm afraid that we're not quite out of the woods yet. So I would suspect our trade tomorrow will be very similar to the Wednesday trade. Eric says, do you have a stock or fund that we should short in some way following China announcing they're uninterested to buy U.S. agriculture products? Yeah, so our Tuesday play, we're buying put options on China. I believe China is in a far weaker economical situation than the U.S. Now, we did have Ray Dalio come out saying, oh, we should buy Chinese stocks right now. Catch is probably, he's managing tens of billions of dollars from the Bank of China. So, of course, Bloomberg, I love to listen to Bloomberg, but they have single-handedly with their index products funneled tons of money to China. So in my analysis, I believe the Chinese economy is very stretched. You can only go build so much housing to support your economy. They have something like 25 million houses that were built. They're just concrete little structures. The average Chinese guy owns like 3 to 4 houses. Nobody lives in them. No one's renting them. They're just wasting away. And now, there's also a lot of YouTube channels where these guys go ride motorcycles around. There's these huge signs with President Xi saying how great China is and how they're building this huge road and belt project, spending trillions of dollars to do so. And then you look at the state of these tier 2 and tier 3 cities in China. They're ghettos. They're ghettos without streets, without, they don't have good water. They don't have good drainage for all the sewage and all the waste. So from the Chinese perspective, they're spending money everywhere else except domestically. And I think China is going to essentially go bankrupt until they come to terms with the U.S. So my bet on that play is to short China through the FXI ETF with a put option.
Hey, Jason, I'm just jumping back in here. I just hopped off a call.
Oh, nice.
So you found videos of guys riding around in China doing that? That sounds cool.
Yeah, there's a couple British guys who they're not really financial forecasters, but they're blogging their experience in China. Yeah, so you get to see the good, the bad, the ugly. They compare all the different cities and all that.
Cool.
And yeah, it's really quite a sham. They're spending trillions of dollars to go develop this Belt and Road, and meanwhile, there's not even paved roads in their tier 3, tier 4 cities. So they have a house of cards that I think can be pretty easily shaken. And so now the media and the banks have a huge amount of investment from the Chinese. So you can pretty quickly, just from the tone of someone's voice and the arguments they make, you can tell if they're managing Chinese money or not. And so it's something I found very interesting when, looking at the Bloomberg guest speakers, the CNBC speakers and such. So yeah, my macro view is that the Chinese, if you imagined getting dunked underwater, the Chinese know they cannot beat us in a fight, but maybe what they can do is they can grab onto us and bring us down with them. So I think that they're willing to put their economy into a depression in order to put our economy in a depression. And I think that's when they feel like they can have the chance to come out of the depression and take the lead. Whereas if they agree to the terms that the U.S. is advocating, it would clearly push the U.S. way ahead back into first place. So from the Chinese perspective, I do think they want to take both their economy and our economy a step back. If they can put us into a bear market, put us into a recession, maybe even into a depression, that's going to cause a lot of problems stateside with a democracy. We're going to have, who knows, Bernie Sanders or Kamala Harris taking over the office. We're going to have the deficits just go out of control. We're going to have the advantages of owning a business in America disappear. So I think that's what they want. And that would give them the advantage to potentially come out of this recession and take the lead. So I don't think the Chinese have any intentions to make a trade pact with the U.S. And so this should escalate. If that escalates, we're going to be happy we own the put option. That's the bottom line. Now, the reason I like to short FXI is because that's an ETF that is 100% concentrated in U.S. or rather Chinese. Yeah, trying to play these small little news pieces. So the U.S. is going to just subsidize the farms with the tariff cash. So I'm not sure if there's an easy play on that, but what I'm trying to do, Eric, is, let's look at the big picture. If we get that right, we're not going to lose a bunch of money. We're not going to win 100% of our trades, but we're going to win a high probability, a high percentage of those trades. And so that's why it's so smart to have half your portfolio in stocks, half your portfolio in bonds. Trying to predict when the next Trump tweet's going to come out. Good luck. We know it's coming. We don't know when. I was actually predicting he was going to raise the tariffs in July. So we're out in Hawaii for Dean's wedding, and I'm trying to make sure we don't lose much money. So playing it super safe. So I've been actually, for anybody who's been following this for a while, been worried that the tariffs would escalate. China does not want a trade deal since June. So a little bit early on that. The peanut gallery was giving me all kinds of heckles all month because we had these puts, and then they paid off. And I don't think the escalation is near over, and I think they're trying to save their fireworks. The closer we get to the election, the more blows I expect from China. So Trump knows if he wants to push the pressure, he needs to do it now. He knows it's going to be bad for the stock market. So he needs to put the pressure on now, force the Chinese economy to collapse, to have extreme pain, so that they will finally realize they need to come to a deal. Otherwise, they risk their citizens revolting. That's their biggest fear. So when you look at it, the bond market looks nice. The precious metals looks nice. We can expect the trade war to escalate. So that's going to force the banks to lower rates, print money. In general, that's bullish for everything. But we know the equities market is hypersensitive to this news feed. So my expectation is we have some more bad news before the FOMC meeting. Also, Trump knows the more he scares the market, the more likely the Fed is to lower rates, which he aggressively has been commentating on. So it seems like a counterpunch from the U.S. is in the cards in the near future. And that's why we have our portfolio position to not lose if that happens. All right, guys, any other questions out there? We still got 15 people in here, so thanks for hanging in there and listening to everything. Harmonic Wealth, I just unmuted you in case you wanted to talk. Any last questions out there?
Hey, Jason, one last thing I want to add is the apartment went on sale this week.
Yeah, SPY is at a discount, and with our trade setup, can't lose a lot, can't win a lot. We just crank out the consistent profits on it. All right, guys. Well, thank you so much for your time. We'll have another webinar next week, same time, same place. We got a trade alert tomorrow morning for you, and then another one on Monday. So thanks so much. And if you want to make sure you get our Tuesday, Thursday trades, just upgrade and you'll get it free for the next 30 days. Call Dean 505-322-7515. Thanks again.
Thanks, team. Look forward to helping you.